Okay, hi everyone. This is going to be the lecture for Chapter 3 in Managerial Accounting, the PowerPoint. Here we're going to be building off of Chapter 2, the job order costing system. So, as I have here, last chapter we discussed how to assign costs through job order costing. This chapter, we're going to learn how to use job order costing to prepare a balance sheet and an income statement. Before we do this, however, we have to review some of the terms from Chapter 2. So, job order costing, right? We'll run through these. I'll read what it says. Anybody can, you could read these yourselves, but I'll try to, help explain it and give some refreshers with it. So, job order costing. This is a costing system used in situations where there's many different products, jobs, or services produced in a period. So, hey, maybe we have a ton of different jean styles, right? We looked at some examples for that. The idea with this is twofold. One is it's different products, and this is in distinction to a very homogeneous product. If we were doing like a bunch of flour or a bunch of like soda or something, we'll see a soda example where it's like all of the same. In that case, you'd use a different costing system. So here, what we're doing is when there's different products or different jobs, we're trying to track the cost of those jobs. In other words, if I came up to you and I said, "Hey, you're making a product there, right? You have a variety of different products. What does that one job cost you, right, in total, and then at a per unit level?" The next idea here, absorption costing. So it says here, this is a costing method where all manufacturing costs, the direct materials, the direct labor, your manufacturing overhead, the variable and fixed portion, are part of the cost of the product. In other words, this is the idea that when you incur costs to manufacture inventory, you do not immediately expense them. Instead, right, you'll put them on the balance sheet, right, as part of inventory, whether it's like your raw materials, your WIP, or your finished goods. And then afterwards, when you sell the product, right, then you'll take the expense for the inventory, right, cost of goods sold. And it's absorption costing, right, because it's like a sponge, right? When we incur these costs to help produce and manufacture the inventory, it gets absorbed into, like a sponge soaks up water, inventory, right? It's not going to be put as an expense immediately. Next one here, right? It says allocation base, all right? So as I have here for allocation base, right, this is a measure of activity such as direct labor hours, machine hours. We basically use this to help assign cost to cost objects. And what we do here is we want to pick the most accurate one that's like best reflecting our product. And we saw this last chapter, right? Traditionally what's used here, like direct labor hours or machine hours, we help to use these as we incur them during the period to apply and assign our predetermined overhead rate. And speaking of our predetermined overhead rate, right, this is a rate used to charge manufacturing overhead costs to jobs. It's established in advance each period. Essentially, hey, at the beginning of the period, right, based on estimates, we determine our predetermined overhead rate. And so what it's going to be is your estimated total manufacturing overhead costs divided by your estimated total amount of allocation base, right? That will give you like a per hour predetermined overhead rate, like whether it's direct labor hour or machine hour. Once we establish that, right, we then go into the process of making the inventory and running the operations. The show goes on, right? And in this way, as we incur the allocation base to make the product, right, we have direct labor hours, we have machine hours. We're going to apply that predetermined overhead rate to it. Right, it's going to be like $6, per direct labor hour times, hey, it looks during the period we had 20 of them, right? So we're going to have $120 of applied overhead. Normal costing, right? This is going to be a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base. Again, just what we're saying, hey, you apply the predetermined overhead rate based on, as you incur the base. And then a job cost sheet, right? This is going to be a form that's going to show us our direct materials, our direct labor, and then our manufacturing overhead costs that are charged to a particular job. In other words, it's like they show it as a piece of paper. I'm sure it's an Excel file. But the idea with this is you could pick this up and look and say, okay, what is job A costing us, right? Well, we could see the direct materials. We could see the direct labor. We could see the manufacturing overhead. Continuing here, right? It says product costs flow through 3 inventory accounts on the balance sheet, and then upon sale are going to hit the income statement as cost of goods sold. So as a general rule, right, we said you do the balance sheet first, and then when you sell it, that's when it affects the income statement, right? Now on the balance sheet, what happens here is we have our raw materials inventory, right? And these are basically the materials that are going to go into the final product. And if we purchase, if we purchase them, we're going to assign these direct materials to our raw materials. We have our WIP, which just means work in process. So it's kind of right, we have like at a simple example, right, just to keep it simple in our heads. Your raw materials, if you're a pizza shop, right, it's like your dough, your flour, your cheese, right? Your WIP is when it's like work in process. You kind of have the pizza halfway made, it's not in the oven yet. And then your finished goods, right? That's like when the pizza's done and people are ready to buy it. Okay, so with our WIP, this is going to be basically our units of product that are partially complete, right? That pizza's partially done. And what we're going to do here is we're going to assign our direct labor and manufacturing overhead to the WIP, right? And then with our finished goods, right, once you were to finish the good, in that case, you're going to take it out of WIP, put it into finished goods. When you sell it, take it from finished goods and transfer it to cost of goods sold. This will make sense. We're going to run through an example, in this PowerPoint of it. We're going to do some examples in the problems. But for the time being, right, let's just hang in there and go through it, right? So this is showing us what's going on here, right? We have our raw material purchases. That's a cost. We buy some raw materials. We're going to put those on our balance sheet, as raw materials inventory. When we then, right, we were to take them, for example, from the storeroom and start to use them in production, right? Like we take the cheese out of the back room and start to use it to make the pizza. We're going to have those direct materials used in production flow down into our WIP, right? And then likewise, when we have our WIP account, right, we're going to charge to that our direct labor and then our manufacturing overhead, right? And with our manufacturing overhead, one thing here I want to kind of tee this up front, right? We have our applied manufacturing overhead based on that predetermined overhead rate. That's what we're going to use here to assign it over to WIP. At the end of the period, we compare our applied manufacturing overhead, our estimated manufacturing overhead, with our actual manufacturing overhead, like what we actually incurred. Things like our indirect materials, our indirect labor, our actual utilities, right? But in any event, right, the flow is from WIP, once you finish it, right, it's going to become part of finished goods. When you sell it, becomes cost of goods sold. So at the end of any given period, right, if you were to start a product, a pizza, it would start in your raw materials, you buy it, you would transfer it from there into your WIP, right? When you finish it, you would transfer it from your WIP to your finished goods. When you sell it, you would transfer it from your finished goods to your cost of goods sold. Now that's like a single pizza, right? Imagine you were making, various different products and you can't just finish them in one day, right? At the end of the day, you got to turn the lights off, shut down the plant. So at any given time, right, you could have a balance in your raw materials inventory. You could have a balance in your WIP, and you could have a balance in your finished goods, right? The initial flow I showed you is kind of the whole process of how a product can go from beginning to end through those three accounts. But like I said, we don't make and sell everything in a single day. So at any point in time, you can have different balances in there. Now, in distinction to this kind of absorption costing idea right here, we're also going to have our period costs, right? These are going to be things like our SG&A, our selling, our general, our administrative expense. We expense these as they incur, right? Debit expense in the period. So let's look at an example here. So let's say that we have Mark Anthony and Cleopatra. And if you don't know who they are, they're like historical figures, essentially around like 2,000 years ago. He was a Roman, she was an Egyptian. They had a romance that was very famous. There were plays written on it, and the idea with it, right, is let's say that this was 2,000 years ago, right? And we're coming up on exactly 2,000 years. And we have a coin company, right? And they're, let's just say they're in Italy or, they have associations with this. And the coin company, they want to make, to commemorate this event, the 2,000 year anniversary, two different coins, right? Two different jobs. And the idea with it is we're going to look at the cost of these jobs in April as they did and worked on certain components of it. Now the jobs here, right? We're going to have job A, which is going to be 1,000 gold Mark Anthony coins. And it looks like those, we started them in March, right? So as of the beginning of April, we would have a WIP, right, of $30,000 in manufacturing costs, right? So we started them in March. We didn't finish them, right? So we have WIP, work in process. And at the beginning of April, we have $30,000 in WIP, okay? And then our Cleopatra job, right? This one, it's a bigger job, so we're going to wait to start in April, right? We're going to say this was incomplete as of the end of April, but the goal here is we're trying to make 10,000 silver Cleopatra coins, okay? So we have two jobs, right? A gold coin and a silver coin. And some of it we've already started, the gold coin, we have a WIP balance. The other one we just started in April. So we're looking at the activity here in April and how we would complete it. So it looks like on April 1st, right, the company had 7,000 of beginning raw materials on hand in their storeroom, right? If you open up like their little vault, it looks like there was $7,000 worth of gold and silver in there and whatever other materials they use to make coins, okay? And then during the month of April, in order to fulfill these orders, right, to complete them, we had to buy $60,000 more of raw materials. So in that case, right, we're going to debit raw materials for $60,000, and you can credit account payable, or you could credit cash, right? The idea here is I'm not as concerned with that. The idea is, hey, we got to put these raw materials here on our balance sheet. So we buy some, and then, hey, check it out. It says during the month, right, we prepared a material requisition form. And this form says this: hey, go into the storeroom, right, where we keep all of these materials we bought, and please take out of there $52,000 worth of the material, right? And of that $52,000, $50,000 are going to be direct materials, right? It's probably like true gold, true silver, right? We would break it out, 28 to job A, 22 to job B. And then, oh, by the way, we have to grab some of our indirect materials too. Maybe there's like glue, other components that go into maybe congealing or getting the coin, either maybe a little chemical or something to help give it the right shape and texture. So in any event, right, what we would do here, if we go back, right, so we have the raw material purchase. We saw that it's going to be raw materials inventory. And then what we did here is we took it from our storeroom and we started to use it to help make these products, right? So when we take these direct materials used in production, we have to transfer it from our raw materials right up here, the debit in raw materials. We got to flip that out, right? We flip it out because we're transferring it to the WIP, right? And the amount we transfer to the WIP are going to be our direct materials, right? You can see here, right? The idea here is the direct materials go into WIP. And the other amount, right, this debit to the manufacturing overhead, this is going to be our indirect materials. And one of the things you have to be cognizant of here in these steps, when we're debiting manufacturing overhead, this is for actual manufacturing overhead. In other words, right, we can actually see and trace $2,000 of indirect materials here. In distinction, right, when we count and use our manufacturing overhead here, and we apply it to the WIP, we're going to use our applied manufacturing overhead. So generally, right, if you see a debit to manufacturing overhead, that's talking about actual manufacturing overhead. If you see a credit to manufacturing overhead, that's going to be applied manufacturing overhead or estimated manufacturing overhead, right? Actual versus estimate. And at the end of the period, we'll true these up, right? We'll kind of make everything even Steven, but for the time being, just be aware of that. So in this case, right, looking at it, we have that materials requisition form, 52,000, right? It looks like 50,000 were for direct materials, 28 were for job A, 22 were for job B. And then these guys right here, these accounts, these are going to show us our raw materials. Looks like we started with 7. We bought 60. And then we flipped out 52 of them into our WIP and our manufacturing overhead, right? This 30,000 here, this was the beginning balance. Remember we said we started the Mark Anthony job last month in March. So that's where that beginning balance comes from. Continuing, right, it says in April, our employee time tickets, they included 60,000 for direct labor and 15,000 for indirect labor, right? So it looks like we had some of our jewelers or the people who were working on kind of the ground floor. We had $60,000 of their direct labor. They were directly working with and producing these items. But we also had 15,000 of indirect labor, right? That would be like the supervisor who isn't directly associated with a single product, or maybe a janitor, right? They're cleaning the floors there and they're serving all the different products. It's indirect labor. So when you have indirect labor, right? The idea with that is it's part of your actual manufacturing overhead, because manufacturing overhead, right, if you remember, you have your direct materials, your direct labor, and manufacturing overhead. Manufacturing overhead is your indirect materials, your indirect labor, and then those other kind of traceable manufacturing overhead items, things like utilities, right? So in this case, right, we're going to debit WIP for $60,000 for those, direct labor, absorption costing. We got to put it on the balance sheet. We, don't expense these as they incur. Debit manufacturing overhead for $15,000, our actual manufacturing overhead. Credit salaries payable, right? So when we have our direct labor, bam, we got to take that over and make it part of our WIP. So, right, this is just saying, right, hey, we had 75,000, 60,000 of it, 40 and 20 are direct, right, direct labor that we're going to make as part of our inventory. And then 15,000 was that, actual manufacturing overhead. Continuing, right, so I have your manufacturing overhead is anything other than direct materials or direct labor. Okay, we just mentioned that. We've already discussed it as it can be caused by indirect labor and indirect materials, right? So the supervisor, the janitor, right? That's like indirect labor. The indirect materials, that would be right, like the glue or whatever little chemicals that are in there. But as I've indicated, right, there's also other indirect costs. So things like utilities, right, property taxes, depreciation. If you have something, associated with the factory that's an expense, that's not like a direct material or direct labor, it will be part of manufacturing overhead. So in this case, right, what we're going to do here is we're going to debit our manufacturing overhead for as we incur them, right? And this is going to be our actual manufacturing overhead, right? You got to keep it separate. Your estimated or applied manufacturing overhead, we're going to do that next. At the end of the period, we'll true it up, but for right now, we're just teeing up, hey, we had $40,000 of utilities. We got to debit our manufacturing overhead for 40 grand. Looks like we accrued property taxes of 13 grand. And then we utilized some prepaid insurance. Okay, so taxes, insurance for 20,000 that we actually incurred. Debit manufacturing overhead. And then it looks like we accrued 18,000 of depreciation during the month, right, related to the machines and items, in the factory. So in this case, right, debit manufacturing overhead, credit accumulated depreciation. So again, you can see, right, this is our actual, tee up some payables to be paid later on, and then we'd have that contra account for accumulated depreciation there. Okay, now we're going to kind of flip things a little bit and look at that applied manufacturing overhead. Right, so in this case, right, if you go back, we looked at buying the raw materials, having them be part of inventory. When we put them in production, it's part of WIP. Then we looked at direct labor, right? If you can trace it directly to the product, it's part of WIP. Now we're looking at manufacturing overhead with regard to applied manufacturing overhead, not estimated not actual manufacturing overhead. So if we go back here, let's find the slide here. So it says during April we had 15,000 of machine hours. Okay, and then it said 10,000 was on job A, 5,000 was on job B. Our predetermined overhead rate, right, at the beginning of the period, we sat down, we look at our estimated total manufacturing overhead. We looked at our total estimated allocation base. We figured it out that it would be $6 per machine hour. And then we said during the period, right, we incurred, in that case, 15,000 of machine hours. Okay, so then we would just apply, right, our predetermined overhead rate times the amount we incurred. That's going to be $90,000. And in this way, right, we're going to, because we base our WIP off of our predetermined overhead rate, our applied manufacturing overhead, we'll debit WIP in that case for $90,000. We capitalize it. These costs become part of the balance sheet. And then we're going to credit manufacturing overhead for $90,000, right? We said the credit manufacturing overhead, you do that for the applied manufacturing overhead. All the other times we've done debits, okay? So if we look at this, right, here's kind of a nice little summary of where we're at. Okay, let's look at job A. We started with a $30,000 balance in there because we worked on it last month. We had $28,000 of direct materials, $40,000 of direct labor, and then $60,000 of manufacturing overhead, right? So it looks like in this case, right, the $90,000 applied, 60 was to them, 30 was to them. We based it off like the pro rata machine hours, okay? So right now, the total cost of job A is going to be $158,000. Likewise with job B, we just started it this month. We put $22,000 in direct materials. We have $20,000 in direct labor, and then $30,000 in manufacturing overhead to get us to a total of $72,000. Okay, and we worked through the steps for how we got there. Our manufacturing overhead, right up here, we have on our left our actual, and on our right our applied. Right, our actual, this was, right, like our indirect labor, our indirect materials, our utilities, our taxes. These are all things we could actually trace that we used. Whereas in distinction, right, this credit over here, that was based on the applied amount, right? We used the predetermined overhead rate based on an estimate at the beginning of the period, applied it to the number of machine hours that we incurred during the period. We get 90,000, right? So we can see here that our actual are greater than our applied, 5,000. Now, we will deal with this, right? Because someone may say, well, that's not really accurate, right? You're missing out, that's, you're not really tracing your manufacturing overhead if you're $5,000 short. We will deal with it at the end of the period. But for right now, right, let's see what it says here. So it says manufacturing overhead, in short, is a clearing account. It's like a placeholder account. Actual manufacturing overhead, that's going to be on the left. Your applied or estimated manufacturing overhead is going to be on the right. Right? So actual over here, applied on the right. Right? We had that $5,000 balance there. So our actual are 5,000, greater than our applied. Now, as I've indicated, right, the only one that's, the only, as I have here, note, only the applied manufacturing overhead, right, this side, the $90,000, is put on the job sheet. Actual was not transferred, right? So that's what I tried to emphasize here. When this shows manufacturing overhead, this is the applied, not the actual. Okay, non-manufacturing costs, right? So these are like in the office costs, or in other words, they're not in the plant. So here, right, these are going to be period costs. They're expensed when they're incurred. Really, no effect on manufacturing overhead or WIP. So things like salaries for for our administrative salaries, like the secretary, depreciation on items in the office, right, not in the plant, advertising expense. When we incur these, right, debit expense, credit cash, credit payable, whatever the form is there. Now, this idea here, this is kind of a a new idea. So we have cost of goods manufactured, and what this means is when we finish the good, right, we transfer the WIP to the finished goods, and what we transfer is going to represent our cost of goods manufactured. So in this case, right, our facts indicate that we finished job A and had $158,000 in WIP. Right, so going back here, our WIP right here for job A was $158,000. We finished it. Right, so in this case, right, what you're going to do is you're going to flip out the WIP, debit finished goods. Right, so a lot of what we've been seeing, right, let me open up an Excel document here. Right, so let me pull this over here. So a lot of what we've seen so far, right, just to show you the flow on this, right, you buy the raw materials, debit, raw materials, credit cash. Hey, you put those raw materials into production, right, so debit WIP, credit, not raw materials, raw materials, right, so tee it up, reverse it out, okay? And then, so our WIP, right, if this is like our WIP meter, it's getting, a little bit bigger there, okay? And then we then said with other things with WIP, right, we're going to debit WIP for things like our direct labor, for things like our manufacturing overhead, our applied debit WIP. And then, right, so the WIP is getting bigger, bigger, bigger. And then, right, once you finish the product, you're going to debit finished good, credit WIP. Right, so in this case, right, it's like taking that WIP right back down, right? It's like the flow here, right? So keep building up the WIP, and then when you finish the good, you get rid of the WIP and put it in finished goods inventory. It's just like raw materials, right? Buy it, then get rid of it. Create the WIP, then get rid of the WIP. You see how it kind of flows through there with regard to the three inventory costs. So that's the idea there, right? We talked a little bit about cost of good manufactured, what we transfer from our WIP to our finished good. That's called the cost of the goods we manufactured, right? So hey, we transfer $158,000 from job A, from our WIP into our finished goods. That cost of the goods that we manufactured, that was $158,000, okay? Then here, right, we have to consider our cost of goods sold. So if we go back, right, we now have our finished goods. Looks like we're going to sell it, and we have to figure out our cost of goods sold. And in this case, right, if you have the journal entry for it, it's going to be two journal entries. One has to be to actually record like the revenue, and the other is going to be recording the expense and getting the finished goods off the balance sheet. So as I have here, right, as completed jobs are shipped to customers, right, we transfer the finished goods to cost of goods sold. In other words, when we sell them, we then flip out finished goods, right? So it's like tee up WIP, get rid of it, put it into finished goods. Hey, then get rid of finished goods, take cost of goods sold. So in this facts here, it says shipments to customers. This can be for the complete job order or for a partial amount of the job order. So it looks like in these facts, even though the total job was 1,000 coins, the amount we actually sold and shipped, right, were 750. And it looks like we sold those for 225,000. Okay? So we know in this case that each coin has a unit cost of 158 bucks. In other words, if we go back here, total cost of this job is 158,000. We then made 1,000 coins, so each one is 158 bucks. We only sold 750 though, right? We didn't sell all 1,000 coins. So what we have to do here then is multiply what we sold, the prorated amount, times the cost per coin, meaning we're going to have a cost of goods sold of 118,500, right? 750 times 158. So the journal entry down here, step one, we got to recognize the revenue. In this case, because we've sold the goods, right? We've met the revenue recognition principle under GAAP. So, hey, we maybe sold it on account, maybe they paid us cash. The idea here, the big one is you're going to credit revenue. In the amount here, right, because one of the things you'll learn with journal entries is it's not only just knowing, what is the debit and what is the credit, it's also figuring out what number goes into the debit and credit. So this is going to be based off of our sales revenue, what we sold it for. In distinction, right, when we record our cost of the goods we sold, right, so what was the cost of the goods we just sold? Well, hey, we said it cost us $118,500, $158 per coin, 750 coins we sold. We got this 158 here because we made 1,000. In total, it cost us 158,000. So in this case, then we take the expense upon selling it for cost of goods sold, get it out of the balance sheet. Our finished goods inventory, we need to take that off. So this guy right here, this is just showing a summary of the journal entries, right? So we go all the way back to the raw materials, the WIP, manufacturing overhead in that case, showing some of our period costs, looking at our finished goods. These are the associated T accounts, right? So this might be something you would see right in your general journal and then like your general ledger over there. Next up, right, it says, as part of the accounting process, when we do all of this, the business has to complete a cost of goods manufactured schedule and a cost of goods sold schedule. And the idea with this is you got to complete this guy first because it feeds in to that one. So we set our costs of our goods manufactured. That's really right. What did it cost us? To make these goods that we manufactured. And in the Mark Anthony one, right, it was like 158,000, right? It's what you transfer from your WIP over to your finished goods. So how you could figure this out for the period, right, if we define cost of goods manufactured as what is transferred out of WIP, what you could do is here, you could back into it, right? You could do your beginning WIP plus your total manufacturing costs added to production, minus your ending WIP gives you your cost of goods manufactured, right? What they're really doing here is they're reorganizing the equation. Normally how it works is you have a beginning WIP balance, you add to it, and then you subtract from it whenever you flip it out from WIP to finished goods. That will get you to your ending. We're just rearranging this equation here, right? So it would start like, let me flip that over there. Right, so normally it would be like what you started with, beginning WIP, plus, right, all of those manufacturing costs that, where we would debit the WIP, right? We saw those journal entries. Then you would subtract from that your costs of good manufactured. Right, so it's kind of like, think about it, this is like debit WIP, debit WIP, debit WIP. Over here, right, we debit finished goods and we credit WIP, right? So we like tee it up, take it out. Whatever you have left over, right, that's going to be your ending WIP. So the idea is there would be a subtotal line there. What they're really doing then is to solve for this cost of good manufactured, you can back into it, right? If you know what you have in the beginning and you know where you stand at the end and you know what your manufacturing costs were every time you debited WIP, and you just solve for the missing variable there. And then this is going to feed into your cost of goods sold schedule, right? So if you're trying to figure out what your cost of goods sold were, you could look at your beginning finished goods plus what you added to it, right? Remember when you get rid of the WIP and you debit finished goods for your cost of good manufactured. And then you're going to back out your ending finished goods. That is to say your cost added to your ending finished goods. Maybe there's some like final details or something you have on the product. It's going to get you your unadjusted cost of goods sold. And then this is where you would take care of that difference between your actual and your applied manufacturing overhead. So that's going to get you your adjusted cost of goods sold. This is high level, right? We're now going to kind of zoom in on some of these items, right? So here's the cost of goods sold manufacturing, the cost of goods manufactured schedule. This is just breaking out, right? You have your beginning WIP, your ending, that's what you solve for. But what are those total manufacturing costs? Well, right, it's going to be your raw materials that you used in production, right? Your indirect materials used in production. You're going to have to back that out of it, right? Remember we said they had, like, what was it, 52,000 or something? If we go back to the first ones up here. Right, so we'd have to back out. Looks like we took 52,000, but only 50 were for direct materials, so we'd have to subtract out from this 52,000 the 2,000 for indirect materials. That's what this is showing right here. It would be like 52 minus 2. Like the net amount is what you would put in WIP. Add your direct labor, add your manufacturing overhead applied. Right, we've done this. This is like the first couple of journal entries, then we did the time tickets, then we did the applied manufacturing overhead where we did the predetermined overhead rate. Your raw materials, right, this is like one of those like Russian nesting dolls where it's like the doll within the doll within the doll. Your raw materials, how you would get that is your beginning plus what you bought minus your ending. That means whatever, what was left there, that must have been what you took from the storeroom and you put into production, right? So in order to do this, right, this cost of good manufactured, you kind of almost have to start up here, get this guy, carry it down. Then go here, get that guy, carry it down. It helps you solve cost of good manufactured, which you then can go over there and help you solve for that. Right, so this is just showing us a detailed example of it based on the facts in our situation. And it looks like, right, and I tried to color code these, right? So the blue here is the raw materials, the yellow is the total manufacturing costs, and then the cost of goods manufactured is the red item. Right, so we would have kind of a summary item here, right, where we have our beginning plus our total minus our ending, right? So we have like our beginning plus our total minus our ending gets us 158. However, right, if you were to break this out and really look in between there, you have to then look at your direct materials, your beginning plus what you bought minus your ending. It says your raw materials used in production were 52. However, 2 of those, right, were indirect materials, so really 50 was put in direct materials. Then we have our direct labor of 60. Our applied manufacturing overhead of 90 gets us to 200,000 in that case. Direct material costs added, so if we started with 30, we added 200, we're at 230. End of the day, we had 72 in our WIP account, which means we must have transferred 158,000 over to finished goods, right? So if you think about it, right, one of the things is just like break it out bit by bit and trace it back to the journal entries. If you try to analyze this whole thing at once, it'll be overwhelming. Start with up here, right? Go back and look at our initial few journal entries. Then start in the yellow, right? Look and see we had the direct materials, right, that we put into production from the storeroom. We assigned the ticket costs, right, from the labor tickets. We applied the manufacturing overhead based on the predetermined overhead rate. Okay, so 50, 60, 90. Right from those journal entries, we're at 200. We started with 30, right? We added 200. We're now at 230. At the end of the period, right, we had 72 in our WIP, right? So if we had 230, but we ended with 72, that means we must have taken 158 out of WIP into our finished goods inventory. No, it's a lot, right? I get it, it's a little bit confusing. But if you unpack it just by like the color codes and take it one step at a time, trace it back to the journal entries, it'll be a little bit more understandable. So now that we have that cost of goods manufactured of 158, we can complete our cost of goods sold schedule. Right, so it's going to be our beginning finished goods inventory. We didn't have any, we never had finished any before this period, so it was 0. Plus we put 158 into it, right, debit finished goods inventory. That means we had 158 available for sale, but at the end of the period, we only had 39.5. So if we had 158 at our max, but at the end we only have 39.5, that means we must have sold, right, 118,500, our costs of our goods sold. And then what we would do in this case, right, because remember we said that end of the period we would update the difference between the actual and estimated or applied manufacturing overhead. This is where we account for it, right? We were $5,000 short their expenses we weren't accounting for. We'll just tack them on here to this cost of goods sold. So our total cost of goods sold, or our adjusted cost of goods sold, is 123.5. Then on our income statement, right, you have your sales minus your cost of goods sold, 123.5. That's going to get you your gross margin. Take all of your period expenses, will get you down to your net operating income. Right, so you could see, right, this one little line item right here, this 123.5, how much work goes into it beforehand, right? It's a lot of work there. It's also like if you've ever seen on the income statement, there's a little line that says like provision for taxes. That's a similar thing. It's like 50 schedules behind that, whole teams of people working on this one little line item. So it's like, it's funny that it's like a small thing, but it's so much work behind it. So this is just saying, right, our predetermined overhead rate, that was based on the estimate. It's going to differ from the actual. If our estimated is less than our actual, then we're under applied. So that was the case here. We were under applied, right? We didn't account for all of the expenses. We were 5,000 short. If your estimated is greater than your actual, then you would have been over applied, right? You would have been taking too many expenses. And when we looked at it, right, we just tacked on our under applied amount, that $5,000, right into the cost of goods sold, right? So if we go back here, we just added on, that's kind of how we account for it, right? But that's like one way you could do it. That's like a simple way. Put it into cost of goods sold, credit manufacturing overhead, so that account is now like even on each side, the T account of manufacturing overhead. In other words, if there was 5,000 on the left, too much, we'll just put 5,000 on the right to true it up, hit cost of goods sold for the expense. That's kind of like the simple way to do it. There is a more complex way, right? We can close out this manufacturing overhead, the balance here, proportionally to our WIP, our finished goods, and our cost of goods sold. It's a more accurate way of doing it. A little bit more complex, but we can look at it, right? So it's a 3-step process. It's going to be a proportional closing of that manufacturing overhead, the $5,000. So first thing, we're going to look and divide our total applied manufacturing overhead of $90,000. Okay, so if we go back to our manufacturing overhead, right? Here's the applied. We were at 90,000 total. We were at 95 here for actual, so we were 5,000 too much on the left. So we're going to take this 90,000 from the applied, right, and break it out into what portion is part of WIP, what portion is part of finished goods, and which portion is applied to the cost of goods sold. Then what we'll do is express each section as a percentage of the total manufacturing overhead applied during the period. Take step 2 and multiply it by that $5,000, right? The under over applied amount. This will make sense when we look at it over here. Right, so we have, in this case, the $90,000, right? So step 1 says, divide that amount from the right side of the T account into what's in WIP, finished goods, and cost of goods sold. Right, so first off, we have to break it out into the 2 jobs, right? That's simple. We said 60 and 30. We based that off the machine hours or the labor hours that were used for each one. And then what we have to do then is say, okay, from that amount, looks like we have 90 total, 15 is going to be in finished goods, 45 is going to be in cost of goods sold, and then WIP is going to have 30. Then it says, express each section as a percentage of total manufacturing overhead applied during the period. Okay, so just basically a percentage, right? Break it into 3 parts and then divide it by the total amount, right? So 16%, if you take 15 divided by 90, 45 divided by 90 is 50%, 30 divided by 90 is 33%. And then step 3 here is, it basically says, hey, take the percentages from here and multiply it times that, the excess manufacturing overhead, so the $5,000 here. Right, so in this case, it looks like 833, 2,500, 1666. Right, so what you'll do is you still get rid of the manufacturing overhead for the full amount, right? You're crediting it. Now it's like balanced, right? There's not that additional 5,000 amount. But instead of putting it all into cost of goods sold, right, like we did in this equation, right, you break it out more specifically based on that step 1, step 2, and the step 3, right? So you debit WIP here of 1666. You would debit finished goods of 833, and then you would debit cost of goods sold for the 2,500. Right, so just to summarize, right, to take a minute or two what we did here. Right, we built off of last chapter. We were talking about job order systems. The last chapter was really just like some high level mechanics of it, right? Looking at what is a job order costing system. Looking at like an allocation base, that predetermined overhead rate, and then applying it, right? We said we kept track of all of that on a job cost sheet. This chapter, we're really looking at how do we use this job order costing to prepare an income statement and a balance sheet, right? And we looked at it, we said the inventory on the balance sheet. So if you're looking to prepare a balance sheet, at any given times, right, your inventory will be broken out between your raw material inventory, your WIP, and your finished goods, right? A product that travels through here that you produce would start with your raw materials. You'd flip it over into your WIP and then get rid of the raw materials. There's some other items you would add to your WIP, like your direct labor and your applied manufacturing overhead. Once the product's done, flip out the WIP into the finished goods, right? And then once you sell the product, flip out the finished goods into cost of goods sold, right? So we could see these items would be on our balance sheet, right? Until you sell it, then you take off the finished goods. And on our income statement, we'd have to have our cost of goods sold. And we said our cost of goods sold has that kind of like, it's like the Russian nesting doll thing, right? There's like 10 different things that roll into it. So this is just a visual representation of that. So with all of this, right, like I said, this is a little bit confusing, but if you take it slow, like one step at a time, one journal entry, and you think about the overall principle of like balance sheet, then income statement, it can help you unpack it a little bit. So I will end the lecture here, and we will see you guys in the problems.